Welcome back to the channel, Crypto Trend Trader, with a quick update on Bitcoin. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. Alright, so we had spoken basically about the trending move and some targets to the up and downside previously. It's safe to say that we have tagged our next target. We fell just short of 11,800. But I would say that more than suffices. I want to start with a fresh chart today, and I want to do just some quick Fibonacci's and essentially like just set the targets on here for those people that are not familiar specifically with like how I achieve the targets and everything. So we're going to go ahead and start with the bullish retrace for like the bearish moves themselves. So what I'm doing is I'm going to go ahead and take our fib retracement tool. I'm going to take it from the absolute top of that last move, the head and shoulders at 12,500. I'm going to move it to the bottom down here from our previous bottom, the low at 9,800. Go ahead and switch that one over to red to show that it is a bearish retracement from the top to the bottom. We've got our move back up, and depending if you're looking at spot markets or if you're looking at the futures markets, we basically moved all the way up to the 786. We got a 78.6% retracement of the move down. So it means that we came back up about 80% of the move, and then we started to sell back off. So we've essentially come back up, and we've got a bearish retracement and so far a rejection. Now, is it possible that we find support and continue to move up? Of course it is. It's still an internal retracement, a bearish retracement, or a bullish retracement of the bearish move until we take out that previous high at the top right here. Okay, and you can see based on the moves that we have found resistance at certain areas here, found resistance at certain areas here, found resistance at certain areas here, and the same way that when we've come back down, we found support at those same key Fibonacci levels. And that's what we're paying attention to, is the interaction between those points. So now I'm going to do one from our last high. Okay, the right shoulder of that same move, and I want to do the same thing. And what we're doing here, we're trying to figure out which one of these Fibonacci's is governing price action, which one is having the most substantial effect on price action. Okay, now look here, we obviously have our bottom once again. We have quite a bit of interaction right here, but not as clear. We have some support after we found resistance, came back, found support, came through, found resistance, came back, found support, came through, found resistance, and you'll see we are interacting with this orange fib quite a bit. So what that means to me is that this Fibonacci is likely governing price action. You can see clear as day the interaction we're having with this. So now in this case, we made it back up once again to the 786, almost to the 886, almost 88.6%, 90% of the move, and then so far we're getting rejection. And once again, if we can come back up here and take out the top, we will no longer be in a internal retracement. We will actually like take out the top and continue moving up. So now what I want to do is I want to look at the bullish Fibonacci retraces inside of the bearish move. Okay, so here we have from the bottom, once again, that same bottom point, to the top of the first peak right here. That was 11,169. And you'll notice once again that we had quite a few interactions with it, support and resistance. When we came all the way up to the top, when we pulled down and put in our low, we came down almost exactly to the 786. Okay, let's extend this out to the right so we can see the interactions continue to take place. We stopped at the 618 bounce, and then we got a stab down to the 786, developed divergence, and then we started moving back to the upside. Once we took out the high of that previous move of the Fibonacci that we drew, we were no longer an internal retracement of this, and we're moving to the upside, signifying that on the micro that we are in fact in a bullish move. We're no longer inside of this Fibonacci. So the first Fibonacci to the upside came down to just short of the 786, but we got down all the way to the 886. So now from that point down at the bottom, we're going to go to the top of the move that's taking place currently. Now, in order to legitimately verify that we may have or have topped out right here, the retracement needs to come back down to at least the 236. Once it tags the 236 from the top point, we can start Fibonacciing from then, and count on that being a potential top for this wave or for this move, which we did. We came up to the top, came back down, touched the 236. So now what we need to see is Are we going to find support here and continue moving to the upside, and then we will have to alter this Fibonacci? Or was that the actual top of the move now, and now we're going to get a retracement? So what I like to do is compare two main things. I like to compare the distance of the wave from bottom to top of the previous wave to this wave, and then I like to compare also the retracement of that wave as well. So the distance from the wave we'll do in a second, but first we're going to look at the retracement. In this case, the retracement was almost to the 786, but we did get to the 618. So a pull down to the 618 here is going to pull down to 10,700. A 786 retracement would bring us down to 10,459. But in this case, because we're looking at Elliott wave and the actual move itself, if we come down and retrace any more than the 382 by more than a wick, we will be taking out the top of the first wave. So if that's our 1, that's our 2, this is our 3, we come down to a 4 right here. If we go any deeper than 382 of this wave right here, of this blue wave we're looking at, we will have done too much of a bearish retracement, and we can no longer call this a valid 1 through 5. So we have a minimum and a maximum target right here to continue validating this wave. Now let's take the range, the distance of that wave from the bottom now to the top of this wave. And one of the rules for Elliott wave is that the first wave here and then the third wave here, the third wave is often the longest, but it's never the shortest. So that means that before we see the fifth wave, if we know the third wave is longer than the first wave, the fifth wave could be any length. It could be shorter than the first wave, it could be shorter than the third wave, it could be longer than the first wave, it could be longer than the fifth wave, because the third wave is already longer than the first wave. So now, in order not to validate it, the fifth wave can be any length, but we have to make sure that we don't come down any lower than 11,154. So far everything looks good for continuation off of the 382, which would be a bullish retracement of this wave right here, the first Fibonacci inside of the golden retrace zone, which is from the 382 to the 618. So far so good. I would expect at least a pullback once we top out down here to 11,162. And then we can use our Fibonacci extension tool now. And I know the chart's getting very convoluted now, but we have to pay attention and see how these fibs interact. We're going to take it from our top of the first wave to the bottom of our potential second wave, okay? And now what that's going to do is it's going to give us our Fibonacci extensions, which is going to give us clear targets for the waves that are going to be no longer inside the internal from the bottom to the 1 right here. So in this case, or 2, I'm sorry. So in this case, we took from the bottom to the 1 was our Fibonacci, and then we did a bearish retrace of that bullish move, and now we're going to do a bearish retrace of the bullish move, which is going to take us down here back to the bottom again. And then now this orange fib, I'm going to switch over to, let's go to pink, and that's going to give us targets for where the third wave is likely to top out at, and that's how we use our extension tool. So if it does a double top, it would be the same top, obviously. If it does a 1.382, that would be 11,602, which is where we potentially top with that first move up, started to retrace, and then we got that bearish looking topping candle, that pin bar at the top right here, basically like a very long wick, a red candle with small amount of body to it, typically a rejection or a topping candle. Shooting star, whatever you want to call it. Now here we're at 11,732. That is the 1.5, the 1.5 times of the previous wave retracement. So what that's telling us is that there's a very high likelihood that we did in fact already top out. Now could we get a push up here to the 786 in red, and that would be the 1.618? Of course we could. There's definitely a possibility to it, but it's very likely that with that candle, with that topping pattern, and with the Fibonacci extension target, that was in fact the top. Now let's make an assumption here. Let's assume that when we do come back down, that we're going to come down and we're going to top out exactly where I said, at the top of the 1. So let's assume that we're going to get our bullish pullback, a very small pullback back down to this point. It would be a double bottom from where we likely looked like we had topped out previously before we got that final move up here and developed divergence. So we're going to take from the top to the bottom once again, which again, that's going to be a small retracement because it's so bullish. but let's see where our targets are going to lead us now. Now we can get essentially an extension target for the fifth wave, and what's likely to happen is we're likely to either get the double top at the same point, the 1.382 at 11,953, the 1.5 at 12,000, or the 1.618 at 12,099. So now we have some clear targets to the upside. Let's see how they correspond to previous price action. That's going to take us exactly back up to the right shoulder, which would be a potential area to top out if we got up to the 618. But the likelihood of taking out this internal retracement now and then invalidating that internal retracement and once again looking at the red fib as the predominant fib is less likely, but obviously a possibility as well. In this case, let me draw on here now what that would look like. Our bottom here, our top of the first wave, our bottom of the second wave, our top of the third wave, assuming that was already put in, our bottom of the fourth wave somewhere in this range, and then of course the top of the fifth wave would be somewhere here in this range. Now, does that look like it could be a potential valid target? The 1 tops here, the 4 does not come down lower than the 1 by more than a wick on a highly leveraged market on a substantial time frame. The 3 tops out and is longer than the 1. It's longer than the 5 as well. The 5 could continue on as long as it wants and even come all the way up and put in a new high, and it would still be valid. So this wave can be anything now, and it's still going to be valid. So that once again is a valid target and has potential for that move. So we could in fact get a move all the way up to one of our other extensions as well. So at this point in time, that's what I'm paying attention to. Now what I want to do is I want to switch over to a longer time frame. Let's go to the daily, and then we're going to look at that same thing, and we're going to look at where the wicks correspond and the potential tops. And you'll see that the wick is only slightly larger than the candle bodies here on the daily, which once again is going to mean that we could pull back down to the 382 exactly, find support right there, and we would not invalidate this pattern whatsoever. And then we could in fact get like even a move up to one of the higher Fibonacci extensions, even as high as like the 2.618, and a new high for this entire move over here at 12,724. So there are just some basic ways that we can use Fibonacci extensions, and then make sure that we validate our rules. Now, Elliott wave theory is exactly that. It's a theory. It's not a proof. It's not a fact. So it's not always going to be applicable. But by using these rules, the likelihood of essentially like the psychology of the market and following this, using it as a tool in our tool belt, once again is going to give us an advantage on the market, because we have clear and defined potential targets for not only the bullish retracement, but bullish pullbacks, but also our bearish ones as well. And then we have external and internal targets that we can pay attention to. Like I always say though, I do not like to call the tops. I do not like to call the bottoms. When I do it with small positions, so that you can gain an advantage on the market. But I would much rather trade with the momentum of the market than try and call absolute tops and bottoms. Let's pull up our indicator oscillators here and take a look at what's going on. We are flipping over the TJD TD MACD to blue. We have the histogram above the slope line, and that's essentially telling us that we are entering into a bullish uptrend and could get continuation to the upside. We are also in the bullish distribution, the bullish control zone or the distribution zone here at the top of the range. So although we could once again get continuation to the upside, we need to be careful because it's likely that this trend is in fact topping out. Now what we want to look at candlestick patterns. Depending on how this closes in the next 30 minutes, if we were to take out the bottom of the previous candle right here around 11,360, that's going to be a bearish engulfing candle at what already looks like indecision in the market and a potential topping pattern. So we need to be very careful of that, and then we also need to pay attention to where our pullback would potentially go, which once again is going to be that 11,064 range. In the event that we start selling off violently, what that would look like to me is an A, a B, and then potential C down, or we could actually have gotten a different retracement pattern, bullish retracement of the bearish dump. But once again, it looks like we have topped out and gotten rejected at the bottom area, at the neckline of the head and shoulders, and that we tried to push up higher but failed to do so. You can say that that's based on technical analysis. You can say it's based on fundamentals, potentials of stimulus. But once again, this is typically a week that you want to be very careful, because now we're doing earnings for the third quarter. And, given the situation and everything, certain companies are going to have positive earnings, and those are going to be the ones that tend to report those earnings, as soon as possible, to try to get that news out there and get that quick little pump off of their stocks, off their assets. But, we're going to get a lot of the late earnings calls that come in, the earnings reports that come in that are going to be bearish because they're going to wait till the absolute last minute and take every possibility they can to take advantage of the other earnings that come in ahead of time that are bullish, with hopes that people will like FOMO in or stay in their positions as long as possible before they start to dump. I suspect that the majority of companies are going to have bearish earnings. I suspect that we are going to get negative news on, the vaccines and all that good stuff, because once again, we've made no actual progress. It's all essentially speculation until we get an actual, till we get one of these actual, tests to finish out, till we get a cure, till we get a vaccine, till we finish our clinical trials. Until then, it's all speculation. It's all just news. It's all just, pumping it up. And we know for a fact here in the United States that as of now and previously, the president is essentially banking on the stock market, not the real economy. He's looking for the stock market to perform well so that he can use that as part of his legacy and attempt to get reelected. This is in no way biased. I'm just telling it how it is. So what you would expect is, every time the markets start to sell off, every time we start to see those dumps, every time we start to see those pullbacks, jump on Twitter, put out some bullish news, try to do whatever you can to hold that up for as long as possible. The closer we get to the election, the more likely it is that they're going to attempt to get another stimulus deal. But the closer we get to the election, the less likely it actually is that anything is going to get passed, because we all know how this bureaucracy works. We all know how this whole, system is set up, that the Democrats are going to do what they can to try to make sure that the Republicans are less likely to succeed. The Republicans are going to do whatever they can to try to blame everything on the Democrats or make sure that they are less likely to succeed. It works both ways. We're in a very bipartisan time, in a situation where everybody should be coming together. We're doing the exact opposite. We're becoming more divided. So we need to be very careful here, because once again, markets are the most bullish at the absolute top and the most bearish at the absolute bottom, and we want to make sure that we are not on the wrong side of this next trade, of this next massive dump, of this pullback, of this crash, whatever it is before it happens. And does that mean it has to happen? No, it doesn't. But does it mean that we are most likely closer to the top than we are to the bottom? Yes, I would say 100% we are definitely more likely closer to the top than we are to the bottom. Is it possible that we just get massive continuation and continue to melt up? Of course it is. Is it likely? I don't think it's very likely. I don't think it's very likely to continue on much longer. But here we have, essentially on the 4 hour, and you'll notice that we put in on the TJD TD MACD a high right here, which was obviously not that high, and then we put in a lower histogram high, which was much higher, with that bearish looking topping candle, and that's putting in a bearish divergence, at which point in time we immediately started selling off. Once again, does that mean we need to sell off and continue to sell off? No. Did we get the hard sell here and then still get another high? Yes, and that's a very, very common signature to fake people out. You get the hard sell, and then we put in a new high, take out all their stop losses, get a run, but it's unsustainable price action, which is what leads to a topping pattern like this. So that's it for the technical analysis today. I'm not going to look at a bunch of cryptos. I'm not going to look at a bunch of markets, coins, all that stuff. I'm going to do it another time. I'm obviously still very sick. I'm feeling better, but still very sick. So we'll do that another time. I want to take a brief moment before we get started right now, and I want to talk about something different. I want to talk about success in these markets and what it takes to succeed. You do not have to be the best trader in the markets. You do not have to be the best technical analyst in the markets. What you need to do is outwork the markets. You need to outwork the other people that are lazy and not putting in the time. And the way that you do that is by putting in your due diligence. Okay? Practicing, charting, looking at different assets, watching important news, figuring out potential catalysts ahead of time, having clear and concise targets, doing things like taking bullish and bearish Fibonacci's, having areas in mind where we could potentially be topping out, where we could be potentially invalidating, the count that we have for Elliott wave, etc., etc., etc. Looking at as many different assets that are market leaders as possible. Looking at potential scenarios that cause a pump or cause a crash. Looking for validation targets for if we break a certain area, get a breakout, retest, we would likely get continuation. Looking for areas that if we break through it, we're going to invalidate the count that we have, so it's likely that the trend has tapped out or we have the wrong count. Setting up all these different things ahead of time. But most importantly than everything, you need to keep a trade journal with clear entries, clear exits, clear targets, stop loss percentages, risk rewards. You need to stick to the predefined conditions that you create ahead of time, that you say and know are going to lead to success over time in these markets. You do not need to buy a lottery ticket and hope and win. You do not need to angrily trade when you have a bad trade or revenge trade when you have a bad trade. You do not need to get greedy and increase your position sizes because you've been finding success in these markets. You need to stick to your trading plan. And if you don't have a trading plan, you need to make one. If you don't have a trade journal, you need to make one. If you don't set targets and risk reward and everything before you take trades, you need to start doing that. And I'm talking about actual trading. If you want to invest in assets, that's fine. Go ahead, do what you want to do. If you want to hope and wish and pray and bet on something big, that's fine, but that's completely different. That's not what trading is. I'm talking about actual success in trading over time. You need to do these things. Okay, if you want to buy Tesla or you want to buy Bitcoin or you want to buy whatever it is, gold, silver, whatever, and you want to hold it and that's going to be your hodl position, by all means, you can do that. Do it based on fundamentals. Do it based on technicals. Do it based on, a feeling that you got or a dream you had. That's fine. Do whatever you want with that. But I'm talking about actual success in these markets trading. You need to do these simple steps. Have a trade journal. Have clear entries, exits, targets. Have your risk reward plotted out before you take that trade, and make sure that even if it's a coin flip and you're not using technical analysis, the likelihood of success, because if you're winning more than you're losing, not percentage wise, you could win 50% of the time and lose 50% of the time, but if you're winning more when you win and losing less when you lose, you will have success. Now, if you take your technical analysis and put that into play and you have a higher likelihood, you win 60% of the time and you lose 40% of the time, once again, you will have success. If you put in your due diligence and you work your butt off and you outwork these markets, you will have success. But you need to do all these things, and when you do them all together, once again, you will have success. And the final thing I want to talk about is position sizing. You need to make sure that as you lose, you do not increase your position sizes. You need to make sure that as you win, you do not increase your position sizes. You need to have clear, defined position sizes so that if you're going to make 100 of these coin flips, you're going to have a chance to flip it 100 times in case you go on a losing streak, to make sure you don't get cleaned out. In the same way that if you're going to flip 100 times and you go on a winning streak, you don't increase your position size and then all of a sudden go on a losing streak and you win 30 times in a row and then you lose 10 times and you're right back where you started. If you do all these things, you will succeed over time. I'm not your financial advisor. It's not financial advice. These markets are extremely volatile. Please do your own research. Trade responsibly. But most importantly, please put in the work and you will find success in these markets. That's it for today, guys. Crypto Trend Trader, and I'm out. Oh, and for all the people that said, well wishes and feel better and get well soon and all that stuff, I greatly appreciate it. For everyone that's in the trading group, once again, I greatly appreciate it. But that's it for today. Crypto Trend Trader, and I'm out of here.